Hi, good morning, everybody. Thank you for joining us for our monthly webinar on the global markets. We have, as usual, with Mr. Sunil Subramaniam with us today, and he will be taking you through the U.S. markets, what happened in the last 1 month, and later on, I will continue with a few sector-specific issues such as what happened in AI, what happens with crypto. I think all those things are affecting the markets now, so we should have a very good discussion on all those topics also. So let's, without further ado, I cannot do enough justice to introduce Mr. Sunil Subramaniam. He's the ex-MD and CEO of Sundaram Mutual Fund. He's been in the industry now for decades, and so I think most of you know him. So I won't go into the details. And Sunil, please go ahead. You can take it from here.
Okay, so can I go to the first slide? So,
Sure.
so basically what we are starting off to talk about, as Ketul mentioned, is the US GDP's growth. The reason we are pointing it out is that no international portfolio can afford to ignore the US. While BayFort's portfolio is not a pure 100% US, it is adequately diversified across geographies. The fact is that the US economy is 30% of the world and the US stock market is 60 to 70% of the world. So any portfolio which seeks to globally diversify needs to take the US into account. For all that China may say about taking over the US as the number one economy in a few years from now and all of that, it remains that in the foreseeable future, the US economy and the US stock markets have to be a key part, and hence the performance of the economy there. As we all know, in the medium term, markets track the economy. So while in the short term, there could be blips, there could be switches, and the economy could do well, markets not do well, and vice versa, right? It's important to keep track of that and understand the reasons behind birth. So first thing is that, as opposed to a general feeling of a US stagflation coming through over the last 1 year, we've been talking about how the tariffs could affect US, both the inflation as well as the growth prospects, and multiple people have called for a kind of a recession. But as you can see, the performance of the US economy has exceeded all analyst expectations right from the beginning of the year. And this is a time of MAGA. This is a time of US becoming more internal centric and less global supportive. Despite all of those and the tariff noises, the intense volatility that came, you're seeing there that against the 2024 growth of 2.8%, 2025 till May is about 1.4, and for the year we'll expect to end with 1.9. While it is definitely less than last year, it's nowhere close to going into a recession. On the contrary, it's on a fairly decent wicket, if I may use a cricket terminology. So when you now move on from the US GDP growth to the next slide, right? The important thing is all of you have been probably subject to a lot of noise saying that the US stock market is only a tech and AI driven market, and the Mag 7 come into play and saying, oh, is there any growth in the US? And even the GDP growth that you showed, how far is it AI driven? I think this is a very key slide here. DJ Transports is a particular tracker. What is that? The Dow Jones Transports Index. Now, what is the transport? Transports are physical good transformation from one place to another. Now, you look at the DJ Transport Index, it's a 9-month high. So the first thing that we need to disabuse ourselves that while the stock markets may be reflecting a lot of the AI-related growth in the prices, the economy itself is not just AI. The way beyond AI, the regular economy is quite pumping quite well. And that, I think, is a key to keep track in terms of the portfolio, because while AI has taken a lion's share of the stock market's growth, it's not necessary that it's going to continue in the future. As the real economy continues to pick up, you will gradually see that the portfolios of those companies will also start showing market appreciation. So important point to keep in mind is that past doesn't necessarily reflect the future. We have to track the underlying economic footprint. And that's telling you that physical movement is on again a good wicket, right? So now when you move forward to questions which have risen because of the market's rise on, is there a bubble forming? So if you go to the next slide, we can see that the first thing that's immediately on the agenda is the Fed rate cut. And as you know, US is a very data dependent RBI is also data dependent, but in the US it's an extreme. And the frequency of the data and the continuous, and the fact that we recently went through a shutdown of the US government meant that data got starved. Hence, markets, those who analyze the market on technicals, so predictions, trying to read in the Fed, have been doing a yo-yo. So if you look, the December rate cut, when you saw those good growth numbers, they felt, oh, there's good growth. Inflation is also rising because of tariff. Oh, there may not be a rate cut. It went down to 25%. Then when you now look at the data, it's now back up to 84%. So it's important that in the US, right, unlike in India, where especially the current RBI governor is fairly stable in terms of his thought process, in the US, the data dominates it. And because every week you get some new data, this keeps yoing. So you have to, as a portfolio manager, keep track of this outlook, because that's what changes the preferences in the marketplace. So right now, the view, bear in mind, for December 10th, and I would still like to remind you there's still 4 more days to go. So anything can happen in the next 4 days. But right now, the probability of market participants saying there's a rate cut is up to 84%. So pretty much you can say it's a done deal. So the market will now take that, discount that already. So if a rate cut happens, don't expect much of a move in the market, because markets will now look at what? At Mr. Powell's eyebrows, at the Mr. Powell's choice of words, at his tone on whether a Jan rate cut is going to happen. And the whole rigmarole and the story will start all over again. But the key point to note here, right? Generally, you look, and especially those people from India, we look at the growth inflation trade-off. And generally, when growth is slowing, is when you expect a rate cut. When growth is rising, there's fears of inflation being stoked, and so there's a rate hike. In fact, sometimes it gets talked out. And you just saw the RBI governor in a time when the India GDP gave 8.2%, the first half was averaging 8%, still went ahead with a rate cut. So you can see that reserve officials, whether the Federal Reserve or the Indian Reserve Bank, are now not purely looking at just as a binary thing, saying, oh, if growth is good. What are the difference? The differences are that now they're beginning to look to the future. They're analyzing the past growth, and they're looking to the future in terms of, is that likely to sustain? Again, to draw attention to RBI governor's speech yesterday, against an 8% first half growth, he clearly mentioned a slowdown to the second half, which was supportive of the rate cut. Second, inflation giving comfort that even if you the cut rates, rising of the inflation is not going to be unduly. So merely going by statistical saying growth path is there, so rate cut won't happen, I think those things are now consigned to the history textbooks. Now is a more dynamic. In the US, the third factor comes in is unemployment, and India, you can probably say the third factor is the currency, right? So to that extent, now the reserve governors balance multiple things and take proactive calls. So one of the reasons why I'm pointing that out is that despite us showing that US GDP growth is on a decent pace, market is still saying there will be a rate cut. Why? Probably because of the unemployment situation and the fact that inflation is still not a worry in terms of the kind of inflation the tariff was expected to provide is not that much. And second, I think the Fed governor has said in many speeches to say that they expect a one-time inflation pop-up due to the tariff, but not a sustained inflation. So these are the nuances that we need to look at. And so the December 10th policy will reset market expectations on a Jan rate cut. So that's what we need to look out. A December rate cut is more or less currently discounted by the market. So now we move on to the next slide. Right. The other thing about the growth, the sustainability of the growth. And this is where, if you see, US, as you know, with a $90,000 per capita income, is a highly demand-driven market. And so demand depends on consumer sentiment. And you can see from the graph on the left-hand side, what is it saying? Saying that after weeks of falling the consumer sentiment, now you're seeing that the trend has risen. Yes, there are jagged trends. It's not a clear one line, but the uptrend. So which means that US consumers have not been impacted by the tariffs in terms of their sentiment. I think this is a very important takeaway, because there was the fear that with the tariffs and most of the tariffs being passed on as inflation to consumers, that they would become a bit disheartened and maybe did not want to spend. Clearly not the case. So you can expect the US GDP for the year next year, that is 2026, also to sustain, because consumer spend ultimately translates into consumer demand. and then to GDP growth, right? And one important factor which is possibly favorably affecting them is the tariff stimulus checks which Mr. Trump has promised. So if you ask them the probability that you think that you will receive it by end of year versus next year, August, there's a high probability of Americans receiving the stimulus checks before August 2026. So when those stimulus checks happen, automatically demand and purchasing will get a boost. So that's another factor which is favorable towards a good US GDP print even in 2026, right? So the next slide then moves into the markets. Now we have heard this view and multiple people who called the 2008 crash have been saying that a bubble is forming, though that person shut down his fund because he said, I can't predict the markets. So, but what is this likely to market bubble? The first thing that we tend to look at is that isn't an over leveraged bubble, which is that companies are borrowing too much and just expecting future growth to come and pay for it versus they're having cash. As you can see, this time, whatever the stock price rise, especially the Mag 7, comes with phenomenal cash balances. I think we've given there Microsoft, Alphabet, Amazon, Nvidia, Apple, Meta, and Tesla. For those of you who can't read the fine print, and you can see that as high as $102 billion is Microsoft's cash pool, and $40 billion is Tesla at the other end. So there is a huge amount of cash at the disposal of the Mag 7. So from a valuation perspective, right, I don't think that you need to correlate the sharp rise in the stock prices to a bubble because the situation is different. They're all cash rich and they can ride over any downturns, anything quite comfortably. So I think this should give comfort to those who are fearing a US bubble or a crash, right? I think this is one of the comforting things that you need to keep in mind, right? With that, as we now look at the next one from an Indian perspective, the rationale for investing overseas. And I think that message, while the table here shows you the long-term track record, that over the last 10 years, you've had a 3.5% average depreciation for the rupee, which straight away adds that return to your portfolio. But you are all aware, the last 1 year, rupee has been among the worst performing currencies. And in fact, last Friday, it took another 1% hit. Now, as a new normal, the 90 big figure has been broken. So now, from a perspective of the currency, just want to point out to you that this 3.5% roughly represents the difference in the interest rates between. Right now, this difference is only 2.5%, but over a period of time, it's been hovering. So why I'm saying this is over the long run, the fundamental way that currency is computed as a comparison with two countries is called purchasing power parity, which is the inflation differentials. As you know, inflation baskets vary. It's hard to compare. So markets, especially the bankers who trade in currency, tend to use the interest rate parity principle to predict the long-term direction of the currency. So if today's rate is at 2.5%, right, you can definitely expect that over the medium term, as long as these don't change, it will be at 2.5%. What has further added the grist to the mill, of course, is the FII pullout. They pulled out $15 billion from India. That has caused depreciation. But more than that, it's also the fact that for the tariffs, weakening the currency is one tool in the hands of the nations. Now, RBI doesn't have to go and weaken it, but give us FIs were pulling out, they did not defend. While RBI doesn't generally track a level, I think the RBI governor has made that amply clear. What they try and see is to maintain a weighted average rate, real effective exchange rate across various economies that India deals with on a trade basis. So from that point of view, on a RER, right, that's what RBI tries to manage, and they manage volatility. But for a medium term to long term investor, right, over international diversification brings the differential in interest rates straight away to you as a currency depreciation gain to your portfolio. So I think with that, I'll conclude this short brief about the international markets, right? And the final thing that I want to say is that we talk about markets, but every market has been performing. So gold clearly has been the 58% return performer. Emerging markets with 28%. Unfortunately, this time India is not a favored emerging market. I think China, South Korea, and Taiwan have walked away with most of the gains. And a global 60% developed markets, 40% emerging market allocation has also delivered a fairly decent return. And then you have the S&P, and bonds, as usual, have been in a single-digit return. So all asset classes and indices have performed well this year so far. So, and these are dollar returns. So to that extent, right, you can add the currency depreciation to if you have had a globally diversified portfolio to your returns, right? So that's why we have labeled this the everything rally. So right now, and what's the reason for this? I think the answer lies to one thing: liquidity. I think the amount that the central banks of the world have sought to use liquidity, I think this started during the 2007-8 crisis. COVID gave a further boost, and now most central bankers feel that that is the solution for all ills. Pumping more money and currency seems to be their way, though it might be a bit of a short-term monetary stimulus, whereas fiscal stimulus through jobs and work is what ideally is a long-term sustainable. But most central bankers are answerable in a much shorter time frame, and hence use of quantitative easing and similar liquidity infusions has been. And as you know, like water finds its own level, liquidity finds its own level and finds the best place to go and park itself. And gold naturally was the case because of what you might broadly call an anti-dollarization. I don't call it de-dollarization. D is more active. Anti-dollarization is more passive in my perspective. That there has been a lack of, I wouldn't say trust, but a lack of wanting to take a risk with investment in dollars by foreign sovereign wealth funds, and hence gold and even emerging markets are a beneficiary of that. So when we then do a portfolio, these are also the factors that we keep in mind, and hence putting everything in a US centric portfolio is also not something that's advisable, because many of these asset classes are a contra to the US. Well, this year so far, all have moved up in tandem. They have different rates of movement. So a globally well-diversified portfolio will attempt to take advantage of these moves too. So the next one, I think, it starts with the AI. So now I'll hand over the floor to Ketul, because the portfolio and the details and AI and what role it plays, he will take you through. So you will kind of excuse me, and I'll request Ketul to take over for the rest of the webinar.
Thank you, Sunil, for the wonderful explanation on the US economy, as well as the points that we should be careful about. We also encourage you to ask questions. If you have any questions, please go ahead and type it in the Q&A box, and at the end of the session, we'll go ahead and take those questions. Aishwarya will be helping with those questions as well. So yeah, one question we recently, in the last 2-3 months, we frequently get is AI versus the dot-com boom, especially with Michael Burry, who was the one who correctly called the 2008 financial crisis. He came up with a big shot on a lot of AI names. There was a frenzy of questions around this. So we took some time to understand what's going on in the AI world and how we can compare it to the dot-com boom. So in the chart over there, you see what happened in the early 2000s with the dot-com bubble. There was a bubble in fiber optics. A massive amounts of fiber optic capacity was being built by the likes of Level 3, WorldCom. All these guys were building massive amounts of fiber optic capacity, expecting that the internet usage will grow at the same rate and will be able to utilize that fiber optics. That is not the case right now. Right now, we are behind the curve. So in the dot-com bubble, the demand was not there, and the utilization rates were at about 7% for the fiber optics that were being built. Currently, the utilization rate of NVIDIA GPUs is at about 80% or more. So if you actually want to use an NVIDIA GPU, unless you are associated with a large company, it's not easy to get access to an NVIDIA GPU. You will be told that please come back after 2 months. So that doesn't indicate a bubble, because for a bubble to happen, you should have lower utilization levels, whereas right now utilization levels are north of 80%. And please remember, these are 24/7 utilization levels. So if the GPU is not being used at 2 a.m. in the middle of the night, that still counts as not being utilized, right? So that 80% is pretty much the maximum you could go. There could never be 100% utilization level because they all have downtimes. They all go through the typical day and night cycle. So I think 80% utilization is pretty much 100% usage that you can get out of those GPUs. Another thing is the physical layer in the dot-com boom moved faster than the software layer, where software proliferation of internet applications was slow and the physical layer was not being utilized. Right now, that is not the case. It is the exact reverse, where the software layer is moving faster than the physical layer because of the various LLMs being developed, the various databases being used to uh, modify enterprise software, to use enterprise software more effectively. I think the software layer is moving at a much faster pace than the underlying physical layer, which is where we have a constraint right now, that not enough GPUs available to support the software changes. So the main difference between the AI boom versus the dot-com boom, right now we have excess demand and no supply, versus in the dot-com boom there was excess supply and no demand. So that is the main reason why we feel that as of now we are not anywhere close to the dot-com boom. So we should not be too worried about this discussion that's going on about the AI bubble around the capex, etc. Moving on to the next slide. So yes, certainly there are capex requirements and those are being implemented. But as Sunil earlier mentioned in his discussion also, this capex is being funded by cash-rich companies. And so those $100 billion, $200 billion capex cash on the balance sheet that you saw, that's not just a stagnant amount. They add another 60, 70 billion every year to that amount, right? So it's not that it's a one and done deal. These companies are cash generating machines. They are generating cash for somebody like a Google at the rate of $75 billion per year. Others may be in the range or slightly lower, but these are all cash generating machines. So every year goes by, you move into another year and another $70 billion comes up in their balance sheet. So that's why we are not too worried about the capex that they are doing. Now, there is a report from Morgan Stanley which says that outside of that cash, you still need $1.5 trillion of new public and private financing is required. Now, the reason we are not worried about that new public and private financing is it will be funded primarily because the returns on those capex investments are phenomenal. If you see Microsoft Azure, which is the AI part of Microsoft Business, their EBIT margins are 43%. If you're getting 43% EBIT margins in a business, funding will not be a problem. To compare, a lot of times we see in India, especially L&D doing very well when a major project is announced. L&D's EBITDA margins are in the 5% range or even lower, right? So if a company with a 5% lower 5% or lower EBIT margins, is expected to do well when they announce a large project with a lot of capex, you can imagine how good it is for a company with 43% EBIT margins. So we should not be worried about the capex spend at Microsoft or Google or any of these companies because the margins over there are phenomenal. I would not be too worried about that. In fact, with this type of EBIT margins, you should be okay with more capex because that will generate more revenues and more returns. So then the next point we get is that, okay, fair. Capex, you can do it. There are good returns on that. What about valuation? Is it in a bubble? Right. So let's take the most well-known case of AI valuations, which people talk about, is NVIDIA. NVIDIA trades at 20 times CY27 P multiple. And the reason I'm talking about CY27 is we are already in December in 25. So come Jan of 26, forward 12-month multiple will be what is the expected earnings in CY27. So we are fairly close to using CY27 as a valuation, forward 12-month valuation multiple. And that's why 20x for a CY27 7 P multiple is nowhere close to a bubble. For bubble, you need to be 80, 90, 100 and above. Now, does that mean that all of them are this cheap? No, all of them are not. Some of them, for example, Palantir trades at more than 100 times sales, forget earnings, right? So there is a wide variety of stocks within AI where valuations are high, mid to low. So it's not that in general, all the AI stocks are either cheap or are fairly valued or are expensive. There are different categories, and so AI is not one sector in itself. There is AI. You can say you can divide into physical, compute layer. You can divide it into semiconductor and compute, semiconductor memory, semiconductor networking. Then you have the enterprise software. You have database software. You have databases. You have consumer software. So all these are different subsectors within AI, and they are all trading at different valuation multiples. So just broadly painting a brush and saying that the entire AI sector is overvalued, I think that does not seem fair. And that's where you make money, where you are aware of those facts and understand which parts are expensive and which parts are reasonably valued to, and which parts are cheaper to go ahead and make those changes. So we do feel that yes, AI overall is not in a valuation bubble, and only maybe 20 stocks out of the 100 stocks or 200 stocks in AI, they could be on the expensive side, but the others are fairly valued to lower valuation. And you don't have to take our word for it. Berkshire Hathaway bought 4.9 billion worth of Google shares, and Google is one of the largest AI beneficiaries, as you can see from the chart on the right-hand side. So, and Berkshire Hathaway is a well-known value buyer, right? I don't need to talk more about Berkshire Hathaway. So and they just bought it in the last 2-3 months. So if they are willing to buy Google shares at the current valuations, which means that it is a value play. It is definitely not expensive. It is nowhere close to a bubble territory. So if you think one of the largest companies in the AI sector, Google, is not in the bubble territory, and with the stamp of approval you get from Berkshire Hathaway, there is no reason to believe similarly valued companies in the same sector with similar or higher growth are anywhere close to bubble territory. Right? So we do feel maybe a few companies are expensive, but the rest of them are not. So moving on to the crypto space. The crypto space has been impacting the stock markets a lot as it grows bigger and bigger. And there was a crash in November. Bitcoin was touched as high as 126,000 US dollars, and it went back to as low as, I believe, 82,000 US dollars or so. And now it is back to in the 90s. So that did hurt the sentiment, especially it happened at a time when there was a discussion about whether the Fed will cut rates in December or not. That was one of the reasons also which precipitated the Bitcoin decline, and that did not help the Bitcoin value as such. But those were some of the reasons. Another reason that we saw for the Bitcoin decline was that there is a company called MicroStrategy. MSTR is one of the largest, second or third largest holder of Bitcoin in the world, and they are leveraged, which means they are buying, they have bought Bitcoin in the past by issuing debt and promising dividends on preferred stock. So now they have to pay those interest and dividends with which they have bought Bitcoin, and that company started trading at a valuation lower than its Bitcoin holdings. So the market speculation was that they will have to liquidate their Bitcoin holdings, and that's why people were selling in anticipation of that Bitcoin holdings from MicroStrategy coming into the market at a large scale. That did not happen, and the chances of that happening for another 21 months are also very low because they were able to issue equity and fund interest and dividends for the next 21 months. So 21 months is large enough in this day and age, I think. And so a large amount of Bitcoin hitting the markets is a low probability as of now. Retail, another thing was because of this scare, there was a lot of retail fund outflows from Bitcoin ETFs. So that hurt the Bitcoin sentiment as well. And so put all of this together and you can see on the right-hand side, there was a straight crash in Bitcoin valuations. And that also impacted the stock markets because people thought stock markets will follow. So what actually happened during the Bitcoin crash? Who were the buyers and who were the sellers? And that's how we are trying to evaluate, what could happen in the future. The Bitcoin wallets, and these are publicly available. You can check this information on multiple public websites because Bitcoin holdings are all public. Bitcoin wallets which hold more than more than 1,000 Bitcoins, which is approximately $91. So individuals or institutions that hold more than $91 million worth of Bitcoin, you see the green chart over there, they were the net buyers in this decline, which means there was a transfer of wealth or Bitcoin from panic-driven individual retail buyers to retail sellers, to the buyers, and the buyers were mostly Bitcoin whales, as we call them. And so anybody holding more than 1,000 Bitcoins or $91 million worth of Bitcoin, they were the primary buyers during this crash. And so, which means that Bitcoin is moving away from a little bit of retail holding to more institutional holding, which provides stability, which will help future declines because retail fund flows will not be able to impact Bitcoin prices as much. So that's a positive. And it also shows that large holders of Bitcoin were more convinced about the value of Bitcoin and they continue to add to their positions. And that's why this is smart money taking over Bitcoins from more of a retail oriented investors. And so that's why this is a good thing. And we do feel that that will provide a lot of support to Bitcoin going into the future. So that pretty much concludes our view about what happened in the AI market with all the news about Michael Burry shorting AI stocks as well as the crypto crash. Those were the two main things that were impacting outside of these were sector specific things. What Sunil discussed was the macro specific things that were impacting the markets in the month of November. So these were the few main things we believe were impacting the markets last month. We do have a few slides on US economy, which is the bull versus bear. We have gone through this multiple times, but one more time I will go through it fairly quickly, but we'll be more than happy to answer more questions on that in the Q&A part. So if you have any questions, please go ahead and type your questions so that we can start with the Q&A session. But in the meanwhile, I'll quickly go through the bull versus bear argument. We have all heard about the bear arguments for the US economy. I will focus on a few bullish arguments. The first and the most important one is the Fed is in an interest rate cutting environment. So we have already had 2 rate cuts so far. We are expecting another one on the December 10 meeting. And another 4 or 5 rate cuts are expected next year also. So this has historically been one of the best times to invest in the US stock markets because, as this slide over here shows, there is not a single instance of negative returns when the US Fed was cutting interest rates. So these are the next 12 months returns after the US Fed started cutting interest rates, going back all the way to 1974. All the green ones are the ones where the US Fed was cutting interest rates in a non-recessionary environment. That is an important distinction. If the US Fed was cutting interest rates like during the financial crisis or during the dot-com bubble, then there were negative returns, as you can see a few, and that also there are only 4 instances of that. But there were negative returns during those times. But at that time, there were major dislocations in the market like the dot-com bubble or the financial crisis of 2008 and 9. But outside of that, without any such major financial crisis, whenever the Fed cut interest rates, the returns have always been the green bars that you see in the chart over there. So the returns have almost 100% been positive for the next 12 months after the Fed started cutting interest rates. So historically, it's been a very good time to invest in US stocks, and that's why we are strongly recommending that. This is a good time to invest globally as well as in US stocks because the Fed is cutting interest rates. The other thing is the fiscal stimulus, which is okay. The central bank is helping the stock market by cutting interest rates. What's the government doing? The government is providing a fiscal stimulus by cutting taxes, and they are cutting taxes to the tune of, for some companies, it's equivalent to 33% of their cash flow. As you can see over here on the right-hand side chart, Google generally generates about 70 to $75 billion of cash flow every year. From the first year of OBBA, which is the corporate tax cuts that were announced, Google is expected to generate an additional 25 billion, which means 33% of their last year's cash flow they will generate this year as an additional cash flow from the One Big Beautiful Act tax cuts. So you have the Federal Reserve, which is the US central bank, helping the stock markets. You have the US government helping the stock markets with tax cuts. And on top of that, you add decent GDP growth, you add decent earnings growth and fair valuation, if not cheap. You put all of this together and it gives you the perfect combination of an era where for the next couple of years, you can see positive returns in the US markets. And that's why we feel this is as good as a time as any that we have seen in the last few years to invest in the US markets. All right, I think that is pretty much it on the US markets as well as our views on different sectors. We will pause over here. Aishwarya, please gather the questions if you are seeing anywhere, and you can go ahead with the questions.
Thank you, sir. Thank you for this valuable insight. We have few questions coming in from our attendees. So our first attendee asked, which global sectors looks the most promising for 2026?
Fair enough. So that's a very good point. I was just going through the slides and I did not mention this slide where there has been a study since 1974 which shows which are the sectors that do the best in a Fed rate cut environment. And as you can see in the center here, consumer discretionary is the one that does the best. And they have returns an average of 6%, and it has outperformed 75% of the times. So every 3 out of the 4 rate cuts in history, all back to 1974, 3 times out of those 4, the consumer discretionary sector has outperformed the S&P 500. So the consumer is a very important sector which you should look at during this Fed rate cut cycle. Some of the other ones that have done well are also there is technology that has done quite well. There is healthcare. So I think all these sectors have done reasonably well during the past rate cut. Go ahead, Aishwarya. Next question, please.
Yes, thank you so much, sir. Our another attendee is asking, could you please share your global market, our portfolio exposure outside the US, along with the relation behind it?
Okay. Got it. So yeah, I think our exposure outside the US markets, we have a European pharma company in our portfolio. We have a company based out of Asia, as well as a company based out of Latin America. They are both in roughly similar businesses. They are from an Indian business perspective, they're a combination of Flipkart plus Bajaj Finance plus Paytm, right? So these are some of the major investments that we have outside of the US. We have an Israeli company also in our portfolio. So let me start with the European pharmaceutical company. I think the pharma sector as such and the entire healthcare sector has gone through a major re-rating on the downside because of Trump talking about a lot of cuts to Medicare as well as the cuts they are expecting from pharmaceutical companies and insurance companies. So that sector has been beaten down phenomenally in the last 1 year or so. And now a lot of that uncertainty is out of the way, which means that a lot of the rate price cuts for pharmaceuticals have been done. They are now almost finalized. So we are getting out of a uncertain, more uncertainty type of a phase where the prices will not be uncertain. Obviously, the demand you always have to watch, but the demand in the pharma sector does not change drastically. And so it's almost always the prices that decide how the pharma sector does in the US. So I think certainty, there is a high probability that the pharma sector in the US, biotech, medtech, just general pharma, they all will re-rate higher over the next 6 to 12 months. So that's a general re-rating. Obviously, companies that are doing well beyond the sector as well, they will do even better. So that's our thesis behind holding pharma slash in our portfolio from Europe. And we do feel that they should do well in 2026. And the other companies that we are holding, they are more of an e-commerce plus digital payments plus short-term financing like Bajaj Finance type of business in Latin America as well as Asia Pacific. The reason we hold that is that the level of digitization in payments as well as in finance as well as in credit is way lower than India also in most of these countries, especially in Latin America and to a certain extent in some of the countries in Asia Pacific also. So the growth over there in credit outside of banks, so what we call NBFCs over here or just general credit cards issued by banks or short-term financing like Bajaj Finance is just phenomenal in these countries. And so these companies that we have invested in, they have provided innovative products where consumers were not getting finance from traditional banks, traditional credit cards. And these companies have provided, just like Bajaj Finance did in India, innovative ways to finance consumers with a decent underwriting discipline. We also want to make sure when the underlying discipline or the credit writing, otherwise it could be horribly wrong. So with the underwriting discipline, these companies have been able to expand the credit business through short-term financing, through digital as well as e-commerce. And so that's why we are very bullish on some of these names in Latin America as well as in the Asia Pacific region like Asia, Malaysia, Vietnam, Thailand. Those are the Asia Pacific names that we are looking at, or the countries that we are looking at. And so yeah, these are some of the major non-US stocks that we have in our portfolio, and we are quite bullish about it. Go ahead, next question.
Yeah. We have another attendee asking, how will the falling rupee impact Indian investors who are investing in global market?
Yes, so of course, the falling rupee is positive for investment side of India because say people invested with us at the beginning, at the launch of our strategy in 1st July 2022. At that time, the US dollar was at about 77 rupees per dollar. So if for investors who invested with us in July of 22, they bought the dollar at 77 rupees to the dollar. Today, if they sell our portfolio and get the money back, they will receive about 90 rupees per dollar, right? So that is a huge gain just in terms of currency. So think one of the big reasons we say that one should diversify globally is that it also helps you in hedging your expenses, hedging your portfolio from rupee depreciation. And as Sunil very clearly and explained that the rupee depreciates at the rate of about 3 to 4 per year typically. I think investing globally is a good way to hedge against that rupee depreciation. So rupee depreciation is generally from a return perspective for investors who are invested outside of India. Go ahead, Aishwarya. Next question, please.
Sir, our another attendee would like to know your thoughts on European defeats as a EU increasingly focuses on self-reliance. So could you
Yeah.
please share your thought on that?
Yes, so with the Russia and Ukraine war, there is a lot of focus on defense in the EU because they are the closest to Russia. And if Russia could attack Ukraine, they could also get closer to Europe and attack one of the European countries as well. And so a lot of defense companies are in focus in Europe. Large countries within Europe are allocating more and more of their spend or rather budgets towards defense. And they obviously want to be self-reliant. They don't want to rely on US or China or for any other country for that matter. But these things take time. You are not going to become self-reliant on defense in 6, 12, 24, 36 months, right? These are advanced weapon systems. You need advanced manufacturing, advanced technology, which they have not developed so far. Europe, to quite an extent, was reliant on NATO for their defense supplies as well as requirements. So it will take time. Will they be self-sufficient in the next 10 years? Sure. Will they be self-sufficient in the next 2 to 3 years? I don't think so. And so I think it's somewhere in between. It's not exactly black and white, but they are moving towards that. But that's the case with any technology, with any industry that they want to start with using what is best out there in the markets. And then they slowly become self-sufficient as they manufacture more in-house or rather inside the country. And so, yeah, I think that's where it is. We do feel there is a certain level of eagerness from the market to invest in European defense companies. And that will continue for the next few years as those defense companies try to make things more indigenously rather than importing it from other countries. Aishwarya, next question.
Yeah, thank you so much, sir. So we have an attendee who would like to know that is the crypto crash temporary or it is a part of a larger downtrend?
Yes, so I think that's what we were trying ourselves to evaluate, if this crash is temporary or it is more of a long-term issue. And for somebody who has followed crypto for the last 15 years, crypto is a volatile asset. You have to be careful with it. And it does go through such crashes every 1 or 2 years. So this is nothing new. We are not surprised by it. And we should not be worried about it also. And crypto impacting the regular stock markets, that is a very recent phenomenon. That has not happened in the past any crash so far. This is the first crypto crash where we are hearing about crypto impacting the stock markets. But I think that is not the case. It's just the sentiment that is similar because crypto investors were also banking on a US Federal Reserve rate cut, and the same was stock. So it does look like they're correlated. They're actually not correlated. The investors are pretty different between crypto and stock markets. However, one I want to point out is that in this crash, the right-hand side shows on the retail sellers were the primary sellers in the market who were worried about crypto and subsequent out from it. But large holders of Bitcoin who hold more than 1,000 coins, they were buyers. Means now slowly the ownership of Bitcoin is away from retail more towards institutional um, owners. It gives a lot of support to Bitcoin. I think long term we are not too worried about the crypto crash happening again, but crypto is, and by definition, it's such an animal that it will be volatile, and so you can see this every maybe 1 or 2 years. But something if you want to keep track of is the ownership of MicroStrategy of Bitcoin. That is a big risk because it's one of the largest holders, and that holding is concentrated within one company. It's a publicly traded, so I think that stock immediately impacts the sentiment on Bitcoin. And so that is one thing that we are closely watching. But now they are well funded for the next 21 months. So till you to the levels, I don't think the markets will worry about it anymore. And so that is also not a problem. So for the we are pretty good on the crypto side.
Thank you so much, sir. I would like to mention here that we are specific. We cannot to conduct any stock-specific questions, so please ask here accordingly. And let's move on to our next question, sir. We have a follow-up question on rupees. So, attendee asked how the rupee declines peaked, and if it start gaining, what would be the impact? And also, despite strong GDP growth, why is the rupee still falling? And do you expect this decline to continue? Could you please share your opinion on this, sir?
Yes, so we are not experts at the currency market, but what we are hearing from especially what Sunil mentioned also was that rupee fell primarily because of two reasons. One is the FPI is selling out of the Indian stock market in the month of November. That hurt the currency sentiment around the Indian rupee, as well as the RBI not coming in and defending it. One of the reasons, and these are just theories floating around, there's no concrete proof of that. RBI may have not defended the Indian rupee to make up for the tariffs that the US administration is charging. So if you think about a 15% tariff, for example, if you are finally going to end up with a 15% tariff on Indian goods, and if you depreciate your currency by 15%, net, there is very little impact on the US, on the Indian exporter, which means that Indian exports to the US will be priced the same. 15% in tariffs and 15% in currency depreciation. They both nullify each other. So the eventual cost to the US consumer for Indian goods will not change even with a 15% tariff. That is one theory that's been floating around, that the RBI is not defending the Indian rupee, and we don't know how long the RBI will continue doing that. So if the RBI thinks maybe another 10% is a good time to not defend the Indian rupee, then the rupee could go down by another 10%. We don't know that. But as of now, in last month, the RBI did not defend the Indian rupee. That's one of the reasons the Indian rupee declined significantly over the last 1 month. But yeah, I think overall, I think there have been very few occasions where Indian rupee appreciates versus the US dollar for a sustainable period. It may appreciate for a week, 10 days, a month, because say last month it lost 4%, then the next month it could gain 1% or so. But it is never the case that it goes back and retains everything that it lost. That has never happened generally. And so we believe that this time it won't be any different. And overall, I think for our portfolios, especially if the rupee depreciates, it gives good returns to the global investors. And consequently, if the rupee appreciates, it gives negative returns or lower returns to international investments. So it works both ways. It's not a one-way street. Go ahead, Ashwarya. Next question, please.
Thank you so much, sir. Sir, could you please highlight once again? An attendee is asking, how does crypto analysis add value when assessing market for an equity portfolio? Could you please add your thought on it again?
Yeah, crypto has been a big topic of discussion, and that's why we decided to add a few slides to this month's discussion. Listen, I think the drivers for crypto valuation and stock market valuation were the same. The investors may be different, so there is no direct correlation. The drivers for those two valuations were the same, and so the impact was roughly the same. The stock markets also declined slightly, but as you can see, the decline in crypto was more than 25-30%, and the stock market declines were in less than 2-3%. So the rate at which crypto declines versus the stock market declines are very different. 2-3% is just normal for stock markets. I mean, if you don't expect 2-3% volatility in a stock market in a month, that's not a stock market, right? That's a bond market. So I do feel that the volatility that we saw in the stock markets in the last 1 month, although there may be some correlation to crypto, it was nowhere close to the levels of declines that we saw in the crypto market. So moving forward, I would not be too worried about the correlation between crypto and the US or the global stock markets. Go ahead, Ashwin. Next question, please.
So, sir, we are avoiding those questions that you have already covered during your presentation earlier. So we are avoiding that. And as of now, sir, these are the only questions, unique questions that been asked by our attendees.
Thank you, everyone, for joining our monthly webinar. We will be doing the same webinar again on the first Saturday of January, and we look forward to having all of you on that call again. Thank you for your time, and have a nice holidays, and see you into the new year. Bye-bye.